Good morning, everyone. Welcome back to another episode of Capital Markets Quickie. I'm your host, Endrit Cela, and today we're diving deep into why inflation rates are dropping faster in the United States compared to Germany. Now, let's talk about this because I do live in Germany, and I think this is very interesting for everyone to listen to and understand the two different situations between the two different countries, not just Germany, but Europe. All right, here's a quick snapshot. U.S. inflation has fallen to around 3%, and in comparison, as I'm sure some of you might have heard the numbers that came out yesterday, Germany's sitting at a whopping 6.1%. Last month, in comparison, inflation rates were at 6.2%. Now, I know it's slowed down a little bit, but it's still double the American rate. But why is that? Well, the United States saw inflationary pressures kick off earlier than Europe. Let's talk about March 2021. Remember, that was the first time when inflation jumped above 2%. Europe, on the other side, took 4 more months to see similar spikes. And while U.S. inflation peaked at 9.1% in June of 2022, Europe was still accelerating, at one point hitting 10.6% by October. Now, here's an interesting piece of information. While Europe grappled mainly with price shocks, and that was and is still due to the Ukrainian war that is going on, the U.S. faced strong demand-driven inflation, which means that the supply remains the same, but demand was higher. And on the other side, out here in Europe, we are dealing with supply chain hiccups and raw material shortages, and obviously higher energy prices. So basically, we have the opposite problem, which means that demand was more or less the same, however, we had less supply. Now, let's talk about central banks because they do play a crucial role in fighting, in combating inflation, and even causing inflation. But here we see the U.S. Federal Reserve Bank, they took action quicker and more aggressively than the European Central Bank. Some of the U.S.'s interest rate hikes were, well, let's just say it, much more aggressive. We had significant interest rate hikes, some of which were at 0.75 percentage points, and out here in Europe, I think the most aggressive rate hike that we had was at 0.5 percentage points. So overall, and over a year, the course of a year, 12 months, the US increased its interest rates by a massive 5.25 percentage points, while out here in Europe, we had a more modest 3.75%. So now let's talk about currency, because thanks to aggressive measures, the US dollar gained strength, making imports more expensive for Europe. Remember the global energy prices I just mentioned? Well, they're mostly in dollars, and well, we had to import a lot of energy out here in Europe to keep things going, and obviously that is inflationary. But with the US inflation slowing and European rates likely to keep rising, the euro is gaining some ground, and we are slowly getting inflation under control. Now, finally, let's talk about the unique situation we have going on in Europe. The inflation rates among the 20 Eurozone countries are, well, all over the map because the countries closer to Russia, like Estonia, for example, well, these countries are feeling more of the heat due to their previous dependence on Russia for energy and goods. So in order for us out here in Europe to combat this, we need stronger and more consolidated internal structures that make us obviously less dependent on external partners for crucial resources. Now, that's a whole different topic for a whole different podcast, or maybe just for a whole different episode, but I'm confident this has served as a very important lesson for us out here in Europe. And that's it for today, guys. That's a quick and dirty version on why the US and Germany are on different points in their inflationary paths. I hope you guys had a good time. I'll see you guys tomorrow with a fresh new episode of Capital Markets Quickie. Cheerio.